Okay, good afternoon, everyone. My name is Avi Gilbert, and I'm going to show you a bit about our Fibonacci pinball method of Elliott wave analysis, which has allowed us to catch most of the major turns in the equity, metals, forex, and bond markets over the 11 years since we opened our doors at ElliottWaveTrader.net. But the one major factor upon which you should really focus is that there really is no other methodology that I know of that puts the market into context as does Elliott wave analysis. That alone makes this method invaluable. So many investors have told me through the years that they know when to buy, some know when to buy, some don't know when to buy, but very few really understand when to sell. So understanding the larger degree of market context will really help you in that decision-making process. But first, we're going to discuss the theoretical perspectives underlying our analysis methodology. So before we begin, I'm going to ask you to please not type in any questions until the end. And I promise to endeavor to get to as many questions I can at the end of the presentation. So please hold off all questions to the end. And thank you very much. So let's get started. Until the times of R.N. Elliott, Ralph Nelson Elliott, the world applied the Newtonian laws of physics as the analysis tool for stock markets. Basically, these laws provide that movement in the universe is caused by outside forces. Newton formulated these laws of external causality into his three laws of motion. One, a body at rest remains at rest unless acted upon by an external force. A body in motion remains in motion in a straight line unless acted upon by an external force. And for every action, there is an equal and opposite reaction. However, as Einstein stated, during the second half of the 19th century, new and revolutionary ideas were introduced into physics. They opened the way into a new philosophical view differing from the mechanical one. However, even though physics has moved away from the Newtonian viewpoint, financial market analysis has not. As Ralph Nelson Elliott noted back in the 1930s, many services and financial commentators and newspapers persist in discussing current events as causes of advances and declines. They have available the daily news and market behavior. It is therefore a simple matter to fit one to the other. When news is absent and the market fluctuates, they say its behavior is technical. Every now and then, some important event occurs. If London declines and New York advances, or vice versa, the commentators are befuddled. Now, Mr. Bernard Baruch recently said, and this is quoting Elliott, that prosperity will be with us for several years, quote, regardless of what is done or not done. Elliott went on to say, in the Dark Ages, the world was supposed to be flat. We persist in perpetuating similar delusions. Now, how many of you have seen markets move in the exact opposite direction you would have assumed based upon the substance of a particular news event? Now, come on, we've all seen this happen many times before in the market. In fact, here is an example of how the gold market moved in exact opposite directions from the exact same news, a rise in inflation, that came out within 24 hours of each other. Now, you see, external events affect the market only insofar as they are interpreted by you and me, the market participants. But such interpretation is guided by the prevalent social mood. Therefore, the important factor to understand is not the social event itself, not the substance of the event itself, but rather the underlying social mood, which will provide the spin to an understanding of that external event. I think Robert Prechter said it best in his seminal book, The Socioeconomic Theory of Finance. And it's a book I strongly recommend to anyone who really wants to gain a better understanding of how markets work. And I cannot recommend it strongly enough. It is absolutely eye-opening. That book will likely shock you with some of the facts and quotes that Mr. Prechter presents. And as you see what he says, you can all read it. I'll give you a moment to read it. I'm not going to just go through and read it with you right now, but I'll just give you all a moment to read it. I believe he presents the manner in which most people look at the market. When a news event seems to cause a market to rally and the news event is positive, people feel good. A news event is negative and the market goes down, people understand, makes sense. When a news event is positive and the market drops, or a news event is negative and the market rallies, people are befuddled. They don't understand that. So they'll just put it on the side and go on to the next set of news. They just completely ignore that anomaly. Don't ignore those anomalies. See, most market participants today believe that fundamentals drive markets. And the reason they believe that is because that's what they were taught in school, or worse yet, by the media. For those that don't know my background, allow me to explain that I don't come at the perspective that I'm presenting to you without an understanding of both sides of the fundamental question regarding the market. Not only do I have a degree in law and a master's of law as well, I'm also an accountant, and I completed a dual major of accounting and economics in college. So I remember learning economics 101 and 102 and well beyond that as well. But in my early learning of economics, I remember being introduced to the efficient market hypothesis as the basis of economic theory, especially as applied to the stock market. Now, I'm not going to go into how ridiculous the basis under which the efficient market hypothesis was developed, but needless to say, one of the underlying themes for this theory is that all market participants have the exact same knowledge and develop that knowledge at the exact same moment. I don't think I have to go beyond that to highlight how ridiculous this theory really is. Now, I'm going to show you something that will shock you. The person who developed the efficient market hypothesis, Eugene Fama, came out and actually said it doesn't work. He came out and actually said to the New Yorker in January 2010, the economics is not very good at explaining swings in economic activity. But do you think the world of economics has abandoned this methodology? Not at all. In fact, it is still taught as the basis for economic theory in colleges to this day. Now, I'm not going to bore you with further quotes as to why that's the case, but it comes down to one simple reason. Economists admit that they have nothing better. Now, let that sink in for a moment, ladies and gentlemen. Economists, and most of you, are utilizing an analysis methodology for the market that does not work according to its creator. And the reason that you still use that method is because they have nothing better to offer. Has that sunk in yet? So let's move on to what I really believe moves markets, and that's market sentiment. Markets can remain irrational longer than you can remain solvent. I mean, that John Maynard Keynes, we've all heard that. Now, there's some, we've heard it from many different places, actually, but it really is mostly attributed to John Maynard Keynes. But let's move on to what Alan Greenspan has said. Now, during his tenure as chairman of the Federal Reserve, Alan Greenspan testified many times before various committees of Congress. And in front of the Joint Economic Committee, Greenspan noted that markets are driven by human psychology and waves of optimism and pessimism. In fact, later on, Greenspan admitted that it's not the Fed that can prevent or stop a market decline. Rather, as he noted, it's only when markets are perceived to have exhausted themselves on the downside that they turn. Not that the Fed turns them. When the markets exhaust all the bearishness, when you read a bearish extreme, that's when they turn. Now, Mr. Bernard Baruch, and he was an exceptionally successful American financier and stock market speculator who lived from 1870 to 1965, identified the following long ago. All economic movements, by their very nature, are motivated by crowd psychology. Without due recognition of crowd thinking, our theories of economics leave much to be desired. It has always seemed to me that the periodic madness which afflicts mankind must reflect some deeply rooted trait in human nature. a trait akin to the force that motivates the migration of birds or the rush of lemmings to the sea. It's a force wholly impalpable, yet knowledge of it is necessary to right judgments on passing events. Now, I got to tell you, Mr. Baruch hit the nail on the head, because about 30 years later, scientific studies will come out to show exactly what he just stated here in writing. Now, Greenspan and Keynes are among the most well-known economists in American history, and Baruch, as noted, was an exceptionally successful businessman. All three have come to realize that markets are driven by emotion and human psychology rather than fundamentals, as most believe it to be. In fact, how often have you heard pundits say that, quote, the market is simply not trading based upon fundamentals at this time? And if you have been involved in the markets for any real period of time, and you're being honest with yourself, there's no doubt you've shaken your head at the market and have muttered this to yourself at one point or another. But these gentlemen have noted, one needs to understand human psychology in order to be able to more accurately navigate our financial markets. So back in the 1930s, an accountant named Ralph Nelson Elliott identified behavioral patterns within the stock market, which represented the larger collective behaviors of the patterns within society in mass. And in 1940, Elliott publicly tied the movements of human behavior to the natural law represented through Fibonacci mathematics. Now, the full theoretical basis for what we now apply as the Elliott Wave principle had been fully developed and publicized at that point. Elliott theorized that public sentiment and mass psychology move in 5 ways within a primary trend and 3 waves within a counter trend. Once a 5-wave move in public sentiment has completed, then it's time for the subconscious sentiment of the public to shift in the opposite direction, which is simply the natural cycle within the human psyche and not the operative effect of some form of news. This mass form of progression and regression seems to be hardwired deep within the psyche of all living creatures. And that's what we've come to know today as the herding principle, which gives this theory its ultimate power. Over the last 30 years, many social experiments have actually been conducted throughout the world, which have provided scientific support to Elliott's theories presented almost a century ago. Let me provide you with just one example of such studies. In a paper entitled Large Financial Crashes, published in 1997, which was by Physica A, a publication of the European Physical Society, the authors within their conclusions presented a nice summation for the overall herding phenomena within financial markets. And as you can see, stock markets are fascinating structures with analogies to what is arguably the most complex dynamical system found in natural sciences, the human mind. Instead of the usual interpretation of the efficient market hypothesis, in which traders extract and incorporate consciously by their action all information contained in market prices, we propose that the market as a whole can exhibit an emergent behavior not shared by any of its constituents. In other words, we have in mind the process of the emergence of intelligent behavior at a macroscopic scale that individuals at the microscopic scales have no idea of. This process has been discussed in biology, for instance, in the animal population, such as ant colonies, or in connection with the emergence of consciousness. Now, later, Elliott identified that these market movements abide by the natural law, as presented through Fibonacci mathematics. In 1941, he stated regarding the financial markets that these Fibonacci ratios and series have been controlling and limited the extent and duration of price trends, irrespective of wars, politics, production indices, the supply of money, general purchasing power, and other generally accepted methods of determining stock values. In recent times, we've even seen evidence that phi even governs man's individual decision-making. Social experiments have been conducted which resulted in price patterns based upon a mathematical standard that mirror those found in the stock market. In 1997, the Europhysics Letters published a study conducted by Caldarelli, Marsili, and Zhang in which subjects simulated trading currencies. However, and underline this, there were no exogenous factors that were involved in potentially affecting the trading pattern. Their specific goal was to observe financial market psychology in the absence of external factors. One of the noted findings was that the trading behavior of the participants were, quote, very similar to that observed in the real economy, wherein price distributions were based on phi. Now, this basically means, folks, that mass decision-making will move forward and move backward based upon mathematical relationships within their movements. This is the same mathematical base with which nature is governed. The same laws that were set in place for nature also govern man's decision-making in mass and even on an individual basis. Now, a few years later, a different study was conducted at the University of California, where they concluded that even individuals make decisions based upon the properties of Fibonacci mathematics. And as you can see, we may suppose that in a human being, there is a special algorithm for working with codes independent of particular objects. Specifically in the study, when subjects were asked to sort indistinguishable objects into two piles, their decision-making within that process divided the objects into a 62-38 ratio. In other words, these individuals exhibited a Fibonacci tendency in their personal decision-making. Now, we know that movements in markets occur within waves as discovered by Ralph Nelson Elliott, and we also know that decision-making are governed by Fibonacci mathematics and the properties of phi, all based upon recent market studies. So how do we apply this to our own reading of the markets to identify major turning points? Well, this is where our contribution to the Elliott Wave world comes in. This is something that I observe within the Elliott Wave structure and have adapted it to a trading methodology, which I lovingly call Fibonacci pinball. So if you remember, I noted when we started that Elliott discovered that markets move 5 waves in a primary trend and 3 waves in a corrective trend. So let's delve into this a little bit deeper, and let's focus mostly on the 3rd wave within this 5-wave structure. The reason I say that is because 3rd waves in the Elliott Wave structure are known to be the strongest and most powerful of all the waves. And it's the ideal wave to trade because of that. Furthermore, since 3rd waves themselves have to be composed of 5 subwaves, it helps us determine how we trade this structure in a relatively low risk manner. Now, let me explain. After the market or stock finds a bottom after a correction, it begins a new uptrend. And such uptrends take the form of a 5-wave Elliott Wave structure. And this is what I have labeled as Roman numeral 1 at the lower left hand of the chart. And you can clearly see we have it structured that there is 5 waves up into the top of that Roman numeral 1. I also want to take this opportunity to point out that each of the waves that move in the direction of the trend, waves Roman numeral 1, 3, and 5, are all comprised of 5 waves each. And waves 2 and 4 are comprised of 3 waves each. So effectively, each impulsive wave can be further broken down into a 5-wave structure ad infinitum. And this is what we mean when we say the market is fractal in nature. It means that the patterns are variably self-similar at all different degrees of scale. Now, moving back to the 3rd wave. Now, since wave 3, I'm talking about going from the bottom of Roman numeral 2 to the top of Roman numeral 3. Since that wave 3 subdivides into 5 waves as well, which we have labeled there, and once we have waves 1 and 2 in place, and I mean waves 1 and 2 of Roman numeral 1 and 2, it makes trading the rest of waves 3, 4, and 5 relatively easy to prognosticate in a standard impulsive wave structure. And this is what I refer to as Fibonacci pinball. So allow me to explain, and we'll go through it step by step. Now, once Roman numeral waves 1 and 2 are completed and set up, We then set up our Fibonacci extensions based upon those two waves, from the top to the bottom, from the top of wave 1 to the bottom of wave 2, and we then set up our Fibonacci extensions from those points. Since Roman numeral wave 3 subdivides into 5 waves, we can use the Fibonacci extensions to provide guidance as to how Roman numeral wave 3 will now develop and subdivide. Wave 1, that's Arabic wave 1 within Roman numeral wave 3, will often target the 0.382 or 0.618 extension of Roman numeral 1 and 2. On this chart, we have it hitting the 618 extension. We will then see a pullback for Arabic wave 2 to the 0.500 or 0.618 retracement region of wave 1. From this point, the market will usually, this is where you're going to see the strongest move take hold going to the upside, and it works on the downside as well. The market will usually target either the 1.0 extension for Arabic wave 3 of Roman numeral wave 3, or as high as the 1.236 extension. In the chart we have here, we have it hitting the 1.236 extension. We will then see a pullback towards either the 0.618 extension or the 0.764 extension, depending upon which extension the market targeted for wave 3 of Roman numeral 3. Now, in the case of the 1.236 extension target, if the market were to break back below the 0.764 extension, about 70% of the time, this is an early indication that the impulsive pattern up will ultimately fail, and then the market will be coming down hard and moving below where the move began. But assuming that the market maintains support at the 0.764 extension, it then moves up from there to the 1.618 extension to complete all of Roman numeral wave 3. As you can see, it then completes wave 5 of Roman numeral wave 3. Now, from this point, the market will usually pull back in a Roman numeral wave 4 pullback to the 1.0 extension, and then begin a final 5th wave rally to target either the 1.764 or 2.0 extension to complete the full 5-wave pattern. Now, of course, this is simply a standard framework within which we track an impulsive wave structure through waves 3, 4, and 5. There can be further extensions, and often are, beyond the 1.618 extension that wave 3 will target. And it will most likely change the targets for wave 4 and 5 as well. But we often see this occur in commodity charts like gold and silver. But the purpose of this exercise is to provide you with a general framework through which you can track most moves for any stock, market, or individual stock of a great majority of the time, and commodity, and so on and so forth. Now, what makes this method so valuable is that it provides natural stops on the way up to lock in gains as each phase completes its upward trajectory. For example, once Roman numeral waves 1 and 2 are complete, such as the bottom of the left-hand bottom of the chart, and you begin Roman numeral wave 3, and you have waves 1 and 2 develop off that Roman numeral 2 bottom, you place your stop just under Roman numeral wave 2. Our entry is usually on the retracement during Roman numeral wave 2, or sometimes we'll wait as long as the Arabic wave 2 of Roman numeral wave 3 if we're a little more uncertain of the pattern as it's developing. Now, as the Arabic waves 1 and 2 within Roman numeral wave 3 complete, you then move your stop up just below the wave 2, the Arabic wave 2. And as wave 3 of Roman numeral wave 3 proceeds to the 1.236 extension, you should most likely take your profit, or at least, I'm sorry, I apologize. Once we move up to the 5th wave of Roman numeral wave 3 towards the 1.618 extension, you should most likely take your profit at that point, or at a minimum, move your stop up just below the 1.0 extension. Now, what you're doing with this methodology is moving stops up to continually lock in gains while allowing the market to continue within its bullish trend. But the reason I say that you should consider taking your profit at the end of Roman numeral wave 3 is because wave 4 is notorious for burning time in a relatively long consolidation as compared to waves 1 through 3. And this will clearly erode some of the time value you have in options that you may trade. For the person who asked me about options when we first started. So now, since your target on the wave 4 is the 1.0 extension lower, you can always re-enter when it gets closer to that target, and you will not lose any significant time factor within the options pricing. You can always get back in. Now, what I'm providing you, again, is a very basic perspective on how we use Elliott Wave analysis and our Fibonacci pinball method. So I know it may not be easy to follow if you're first being introduced to this today. In fact, most of my students and members find the multiple wave degree discussions of waves within waves as being one of the tougher concepts to grasp. So if you don't get it right away, it could take a bit more time. You take a little more time with it. I'm sure you'll be able to pick it up, and it is quite well worth it. So now that we've gone through our general methodology, I want to take a few minutes to just note some of our major calls over the years. We can show you how this has worked for us in exact opposite way of the way most people in the market think. Now, each time that we've used it, it has allowed us to make some sometimes shocking. I mean, literally, we've had people say that it's a shocking market call when we come out with it, which have been quite opposite to the common expectations of most market participants at the time. And that is the true power of this analysis methodology. You can see a movement develop which will be exactly opposite what most market participants believe could happen. Now, while this is not a market call I discuss very often, many of our members think this may have been one of the most remarkable market calls we've made through all our years. And it was actually one of our first market calls. Back in 2011, when the dollar index was down in the doldrums in the 73 region for the Dixie, we called for a multi-year rally with a specific target of the 103.32 region. Now, for those of you that don't trade in the Forex world, calling for a 40% rally in a currency is a significant expectation. But not only were we expecting a 40% rally, for those that remember that period of time, you would remember that the Fed was heavily involved in its QE programs. And that caused everyone and their grandmother to be certain that the dollar was going to collapse. Now, the certainty that the dollar was going to collapse due to the quantitative easing process was absolutely ubiquitous. And to call for a 40% rally in that environment had many looking at me like I was simply off the wall crazy. Well, as we know today, not only did the dollar rally in the face of unprecedented QE, which supposedly to have caused it to crash, but it reached a high of 103.82, just 50 cents beyond our long-term target before it topped, and provided us with a multi-year consolidation that we expected before it continued on higher. As another example, I'll take a moment, to mention our views on gold and even show you some of the things we said back then. And back in the summer of 2011, again, going back to 2011, when gold would rally as much as $50 in a single day, for those of you that remember that period of time, everyone in the market was certain that we were going to exceed the $2,000 mark that year. In fact, the way pundits, analysts, and investors were talking that summer, not only was 2000 a foregone conclusion, the real arguments were really about how much beyond 4,000 we were going to go. Yet back in August of 2011, I wrote the following. As we now know, gold topped within I'll let you read that. I apologize. Clearly, I was calling for a major top in gold at the 1915 level. And remember, this is at a time when the gold market was going parabolic. Now, as we know now, gold topped within $6 of our target at 1921. And even before gold topped, I outlined my expectations for where the pullback can take us. And I put that in the comments section when people were asking me. I noted that if we broke a certain level of support, then I can easily see gold dropping back down to the 700 to 1,000 region from the 1900 region. And since I wrote this while gold was still in the midst of its parabolic run, I'm sure you can understand how those that read this analysis viewed it. Let's just say that the kind commenters were telling me that I was crazy. Now, as we now know, gold dropped down to the 1050 region before it bottomed. However, what was incredible is that during the entire decline, all the fundamentalists who were uber bearish at the highs, I apologize, who were uber bullish at the highs in 2011 remained bullish all the way down. In fact, silver took a 35%, a 75% cut, a 70% cut, and they were bullish all the way down. What was even more incredible was that as we were approaching the 1,000 region, only then did they all turn bearish. It was truly astounding to watch it happen in real time. Almost in unison, the belief became that gold would certainly drop below 1,000 before we would even consider a bottom being struck. But again, we began looking the other way. As you can see, I put this out at the end of the year. And my suggestion was be a buyer over 1,000. In fact, the night that the gold market actually struck its bottom, I was on the phone with Doug Eberhardt of buygoldandsilversafely.com. Some of you may know him. And I put my final order in for my purchases that night. And I informed my members I was doing so within our trading room. And yes, that was the actual bottom struck that night in gold. And we have been within this multi-year rally ever since. I'm going to take you through just two more examples and a few other markets to explain how it works in all markets that you can trade. So let's take a look at the bond market. Now, for many years, many were calling for the end to the bond market almost weekly. And as we know, they have been continually wrong. But on the 27th of June 27, 2016, I wrote an update for our members entitled, "Beware of Bonds Blowing Up." Now, within that update, I was calling for a local top in the bond market with the expectation of a large correction. When I was calling for this top, I was getting quite a bit of pushback from my own members because the Fed was still lowering their rates. So I was told I simply cannot fight the Fed. Well, as we now know, within 2 weeks of that article, the bond market struck a local top and proceeded to drop 22%. Then in November of 2018, I was again telling those who followed my analysis that bonds were looking like they were finally bottoming as we approach my major support region noted on my chart, as I identified by our Elliott Wave analysis and Fibonacci pinball structures. In fact, I noted in our chat room that I was buying TLT when we struck 113, and my initial target for the turn higher was in the 124 region before I thought we would see a pullback and then head much higher. Now, if you remember that time period as well, the Fed was strongly signaling that it was continuing down the path of raising its rates at the time. And again, I was getting pushback because you simply cannot fight the Fed. Well, we now know how that turned out as well, don't we? The market bottomed exactly where we expected and then began a rally to the 179 region before we began the current correction we are now within. Now, for my last example, I'm going to go back to the COVID crash of March 2020. Now, as the market was dropping quite precipitously toward our long-term support in the 2200 region, I advised our members that I was buying big time in that region, as my expectation was that the market would rally off that region to at least the 4,000 region and potentially much higher. In fact, I even wrote public articles outlining the same perspective and was summarily made fun of by both investors and analysts alike. Now, as you can see, this was taken straight out from a comment section to that article. And the person was basically saying, there is just no way possible that what you're saying can happen. And as he put it, the idea is absurd. We're not going to magically get there. It is absolutely absurd. So, he said, how can you ignore everything that's going on in the world and make this type of call? It is impossible for this to happen. I got many of these, but this one is probably one of the best that another analyst actually said to me at the time. Second. What this analyst said was, coming from someone who still thinks the bull market of January is still alive enough to carry us to 4,000, that's highly unmeaningful. Here is the 2,200 exactly that you said the S&P would bottom at before taking the trip back up to 4,000. What do you want to bet? The economy is going to pull it down a lot further, and that 4,000 is a lot further away than your charts ever said. This bull market did not ever come close to taking us to 4,000 and is not going to take us anywhere near ever again because it is dead. And by the way, the capital letters were his doing, not mine. Officially and in every way, every index is deeply into bear market now. The bull is dead, and so it can never take us to 4,000. What you predicted can never come true now. My own resolution is this market, yada, yada, yada. So you have that common sense view, or you can believe Avi's chart magic will get you through all of that and is right about a big bounce off of 2,200 all the way back up to 4,000. I think you get the gist. Now, if you remember that period of time, folks, though, the fear was beyond palpable. It was thick. And, I really can't blame these people for these type of perspectives. What I said sounded absolutely impossible. In fact, I believe the fear that we had at the time was actually higher than the fear that I remember back in March of 2009. So let me tell you a quick story. My wife handles our 529 savings accounts for our kids. Before the crash began in January of 2020, I told her to take the money out of the market because you can only make 2 moves a year in those 529 programs. Told her to take the money out of the market in January of 2020 and leave it in cash in their accounts. She did this without question. But when I told her in March of 2020 to put the money back into the market as we were approaching the 2,200 region, she looked at me and asked me, "Are you sure?" And this was my own wife. But I think we all know what happened from there as the market ran to as high as 4,800 before we got the expected pullback we wanted to see into 2022. And I warned of this pullback in late 2021, which I said, expect the largest pullback we've seen since we struck the bottom in March of 2020. Now, admittedly, the pullback this year was definitely deeper than I had initially expected. I'm not going to go into those specifics right now. Now, while obviously there's no method that is perfect, I've not found any method that provides you with market context in the way that our Fibonacci pinball system of Elliott Wave analysis does. Nor do I know of a methodology which can identify major turns as accurate. Again, while there is no method that is perfect, this method provides us with the market context that I have never seen from any other methodology. It gives us very strong warnings as to when a rally is nearing completion, as well as when a decline is nearing completion, as you can see from the examples above that I just presented to you. And the most important thing is that it allows us to tune out all the noise and emotion that is prevalent throughout the rest of the market and only focus on what really matters, and that is price. As one of our members once said, and why can't I get this to go? There we go. The goal of Elliott Wave analysis is to analyze sentiment and not participate in it. So that is my presentation in a nutshell. And let me see if I'd be more than happy to take some questions now that you may have. What about when the market goes down? It applies in both directions. Remember, depending on what it is, are you talking about a corrective market? Are you talking about an impulsive market to the downside? The structure tells us that, and it tells us how to track that. What do the fib waves look like when the market goes down? Exactly as they look like when they go up. How do you know when to start your first wave, wave one? Well, first of all, you start it after correction is completed. For example, where you started a wave one was the bottom of the market in March of 2020. Off of that low, you had a wave one developing, and then you got your wave two, and then you developed all of that. And for those of you that were following me all the way up to the 4,800 plus region through those years, and you saw me calling both the tops and the bottoms, even on the small pullbacks, this is the reason we're able to do that. Because what our Fibonacci pinball structure does is it presents an objective box around the standard Elliott wave analysis that gives us pretty good guidance as to where tops and bottoms are going to occur at basically all different degrees of the trend, all different degrees of the waves. You had called for about I said I'm not going into the specific analysis of the S&P right now. That is beyond the scope of what I am doing here this evening. This evening, we're really talking about the methodology and how to apply the methodology. So please, let's try and keep the questions focused on the topic, please. I'm not going to go into the specifics. I do other presentations. I'm doing a number of personal presentations as well as online presentations over the coming months. You can tune into that if you like, but for now, I'm not going into any specifics. It would probably take too long to explain. Do we have any other questions, ladies and gentlemen? How much of the EW structure do you think has been discovered? What probability would you assign to a properly? Okay, that's a good question. How much of it has been discovered? I mean, the basics are discovered. The question is the refinements to such basics. For example, we came up with a Fibonacci pinball structure. Is somebody else going to come up with something that's going to refine it even more? Probably. I mean, I can't say no. I would say probably. What probability would you assign? People that have tracked our work assign a 70% probability to our work. I would say certain structures that once they develop are probably as high as 80% probability. Is there a way of those of us who haven't done all the study to get a rough idea of where things are? Well, I mean, we provide analysis day in, day out, every hour. We're constantly providing analysis on our website. If you guys want to come by, ElliottWaveTrader.net. We not only do we provide analysis, but we also have basics that we teach to our members. We teach basics, intermediate, advanced. We have a beginners analyst that just works with beginners. We have beginner webinars, live webinars, 3-4 times a week that go over where we are in the wave counts and do the basics of Elliott wave analysis to indoctrinate people into understanding the Elliott wave analysis from the basics going forward. So we try to get you guys up to speed as fast as possible. What time frames you look at for the waves? Well, it depends on the time frame you're looking at. I'll look at anywhere from a 5-minute to a monthly. It really depends. Depends on what you're going to trade. I say this to everybody before whenever somebody walks into our door at Elliott Wave Trader, there is an open letter. They get a letter from me straight out. Every single person that comes into the door gets this letter. It talks about risk management, and it also talks about knowing yourself as either a trader or investor. What are you? Are you a trader? Are you an investor? You have to learn what you are within the market to best serve your own purposes. If you're really an investor, you have no business trying to be a trader. If you're a trader, well, I shouldn't say that. If you're qualified to do it, I will tell you, being a trader is very difficult because you have to be exceptionally disciplined. Very few people are. Most people like to fashion themselves and view themselves as a trader because it sounds so sexy. Most people who are traders or attempt to trade lose money. You need extreme, very, very precise ability to be very focused and be able to cut a trade if you know it's not working. Very few people can do that. Very few. Why do wave 4s take longer to complete? See, wave 3 is, like I said, a very powerful move. It is the strongest move you'll see in the market. And once that wave 3 completes, you have so many people in the market that really don't understand the market. They've seen this massive move in the market. And what are they thinking? I got to get in. I got to get in. So once wave 3 completes and the wave 4 begins, what you most often see is the handoff from those who really understand the market to those that don't, the chaser crowd. So those that are trying to get out at the right time as the wave 3 is concluding are now selling to those that have seen this massive move and are coming in, the ones who really don't understand. And that is where you have a wave 4 take shape. And that's why it's so variable. It goes back and forth and back and forth. The people that are in the know are out or coming out, and the people that want to get in because they saw this massive rally they missed are coming in. And that push and pull is what causes a fourth wave to take shape. And it takes a long time relative to how a third wave takes shape. And there are actually, in the seminal book on Elliott wave analysis, the Elliott wave principle, they discuss, that's written by Frost and Prechter, they discuss the various personalities of each wave. So that's something very interesting to read as well. Why is wave 3 the most productive wave? Well, the reason wave 3 is the most productive wave is because it is the fastest and technically strongest wave out of the 5-wave structure. Now, in commodities, you could get a wave 3 and a wave 5, where the wave 5 could even be stronger than the wave 3. But as a general rule, the third wave is the wave you want to be involved in. It is often the strongest from a technical power standpoint, as well as the fastest moving of the waves. And especially if you trade options, that is a money-making machine. So that usually, and that's why I tell people, never, ever, 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 and I strongly discourage using any form of leverage unless you are in a confirmed third wave, because when you use leverage, the decay will kill you if you're not in a third wave. And that's why understanding the larger degree structure of the market is so important. The wave structure you presented highlights price moves up and down. How does the methodology address time? That is an excellent question, and I go into depth about this sometimes on my site. I have done extensive market analysis, market history research, and methodology research. I have learned so many different methodologies I can't even explain anymore. One of the things that I've done, I probably did a couple of years of some hard study on timing cycles, various different timing cycles, whether it's Hertz or Fibonacci or various different timing cycles. I will tell you, I have not found a single timing cycle that is better than 50-50. Now, effectively, it means you're dealing with a coin toss. Some people swear by this, some people swear by that. I will tell you from my own experience, timing, I do not believe, is something one can glean in the market. You can, come up with a general guesstimate, maybe based upon trend channels and so on and so forth, or what have you. But I am not convinced that timing per se, based upon actual time, linear time, I don't believe that is something that can be gleaned in the market. And the reason I've actually come to that determination was from a theoretical standpoint, not just from an empirical standpoint, in seeing what people have done with it and how these methodologies work or lack thereof work. But from a theoretical standpoint, if we understand that markets are non-linear, markets are not linear, okay? How can you take a linear timing box and place it around a market? And that's where I struggle a bit, at least from a theoretical standpoint. And every single cycles analyst that I have spoken to has never been able to adequately answer that question and how they handle that issue. Where's the preferential point to get in for wave 3? Again, it depends on, is the structure clear? If it's a very clear structure, then the Roman numeral 2 that I noted before. Here, let me go back. I'll show you. Hold on a second. If the structure is it's a really nice clear 5 waves, and you have a nice ABC down into a clear retracement, and you have and remember I said you have to look at in each and every one of the waves, you have to do your homework. So in the ABC pullback in wave 2, our waves A and B, C, our waves A and C approaching a Fibonacci relationship between those two. And since a C wave in wave 2 is a 5-wave structure, is this 5-wave structure coming to a termination of its own individual 5-wave structure in that decline? So we look for multiple confluence points to tell us if wave 2 is a good buy. If it's still a bit unclear, then you wait for the next 1-2 to take shape, and then you buy this wave 2 pullback and you put your stops just below this wave 2. So there's more than one ways to skin a cat in getting into a market, especially if you want something with a lower risk profile. Okay, what tools do I combine with EW? Well, I mean, there are a number of tools I combine. We have a number of analysts on our site that have proprietary methods that I'll look at as well. I also take into account, MACD is probably my favorite technical tool, but I'll look at RSI and stochastics as well. So, all the different technical methodologies that I like and have worked with in the past, I like to use in conjunction with my Elliott Wave analysis to tell me if I'm on the right track. As an example, when I'm looking at a wave 2 pullback, am I seeing a positive divergence between this A wave low and this C wave low? If I do, great. That supports my Elliott Wave analysis here. That's just giving you one example. Okay. This is a wave 2. Any other questions? Believe me, I have checked out cycles ad nauseum. I'm just not convinced after all the work I put into it. Please explain red count, yellow count. I will utilize color sometimes to sometimes you see a primary count and an alternate count. You also utilize color to designate primary count, alternate count. It's just another way to distinguish between the primary and the alternate count. Other asset classes you notice are traded better or worse using EW. That's interesting. I've always loved trading metals, and it's interesting that often, not always, but often Bitcoin also sees some of the purest Elliott Wave structures, believe it or not. How do I analyze sentiment? I don't have to analyze sentiment. I have to analyze the structure of the market, and that's telling me where we are within sentiment. For example, when I see a major top occurring, I understand that sentiment is overly bullish. When I see a major bottoming occurring, like March of 2020, I realize sentiment is overly bearish. That's how I look at sentiment. And you could look at that, you're talking about a major top, a minor top, a small degree top. It really is depending on the degree you're looking at. And there's no one right answer or no one right perspective. It all depends on who you are as a trader. Do you want to use a 5-minute chart? Or an investor? Do you want to use 60-minute, daily, monthly? Where are you as an investor will answer a lot of your questions. As I always get this question: is now a good time to buy? Is now a good time to buy? I don't know. what is your risk profile? What is your time frame? Is now a good time to buy? Is never a question that has one answer. And even if it is, there are people with that don't want to take as much risk. Maybe now is a good time to buy, and you could just take an initial position, and you could utilize the wave count to your benefit in identifying how you can layer into a position rather than all at once, which is something I strongly suggest. I strongly suggest that at bottoms, and I also strongly suggest it during rallies. You have to pick your points as to where you're going to get out of the market. Let me give you a quick example. I bought into, and as you saw, I showed you, we got into the gold market. Not only did we get into the gold market at the right time, in the last quarter of 2015, we saw that miners were hitting their lows potentially before gold. We actually rolled out a mining service in September of 2015. If you go back and look at the miners, that's when the miners bottomed. I bought NEM in the last quarter, Newmont Mining, for those of you that know it. I bought Newmont Mining in the last quarter of 2015. And I said, I'm going to sell it when we get to my target for the fifth wave. In April, Newmont Mining went to my target, which was around the 84, 85, which was my minimum target. And I sold. Go look at what the market did after that. I challenge you all, go look. And I told all my members, I'm selling my Newmont Mining stocks right here, the ones that I bought in the last quarter of 2015. So it gives you a very, very good perspective as to where the market's getting overheated. You want to raise cash there, and as to where the market is bottoming, where you want to deploy cash. Based upon your comment on EW and Bitcoin, perhaps EW suited to volatile markets where emotional herd instinct. Guess what? Emotional herd instincts kick in all the time. And it depends on the degree you're looking at. You could see it in every degree of chart. Where is current sentiment? Well, again, if in order for me to answer that, I would have to take you through the way the charts look now, and that's really beyond. Okay, how do I take volume into account? That is a great question. And the answer is sometimes I'll have to ignore it because sometimes it really does not matter. For example, if somebody were to be overly concerned with volume, then they would not be in the market since 2009. Because since 2009, volume really has not been as high in most of that rally. Volume has not been terribly high. Volume has not supported this rally to the extent one would expect. Why is that? Well, if you remember, I said the third wave is the strongest of the wave structure. Our third wave, if you look at 100+ year structure in the stock market, our third wave off. Now the second wave ended, by the way. The second wave of the current major structure we're seeing was triggered by the 1929 market crash. So, and then it dropped into a second wave. The top of that third wave is where we're approaching in the market over the next year or two. So we haven't hit it already, and I don't think we have. But that will end the third wave, which began after the market crashed in the 1930s. So the third wave of that final wave ended in 2000. And if you look at a very long term in the market, you will see 2000 marked the top. You dropped, I think it was to 2003. You rallied back up to 2007, and then you crashed down in 2009. You have this long 9-year sideways consolidation. That was a major fourth wave. And we are now in a major fifth wave, which began in 2009. The third wave are the strongest technically. The fifth wave sees weakening technicals. And that's why volume is probably not as substantial. So you have to know where to look for what indications in the market based upon the overall context of the market. Does RSI play a role in my analysis? Like I said, I like MACD better than RSI, but I will look to RSI at times. It is now 8 o'clock. I believe that is our end time. Are there any final questions before we bid each other a good night? Okay. Well, I thank you all for joining us this evening, and I wish everyone a very, very good evening. Thank you very much for attending.